All right, what's up? The BYOB Money Multiplier Ask Me Anything. Here we go, February 4th, baby. How's everybody doing today? We got the whole team here ready to answer all of your questions. So let us know how your start to 2026 is going. Let us know if you were on the 3-day virtual event this weekend, what you thought about that. A lot of people on here were presenting, did a great job. And but we're here to answer all your questions about infinite banking, becoming your own banker, real estate investing, and what other any other financial topics you want to throw at us. So let's do this quick little intro video. We'll do around the horn and we'll get to answering all those questions. Be right back. All right. What's up, guys? Welcome back. Welcome Facebook. Welcome Instagram. Welcome YouTube. Welcome wherever you're watching us today out there in the world. We look forward to answering all your questions. My name's Stephen Nagy. I will be helping the Money Mentor gang, but let's do some introductions and start with the man of the hour, Mr. Brian Fouts, the host of AMA.
News to me, no. Hey, everybody, Brian Fouts here, up in the Pacific Northwest, and big screen now, big screen. Yep. So yeah, the 3-day was awesome. I really enjoyed the last. I think it was the last speaker that did the mobile home one. I really liked that one because that's something I'm looking to get into here and on my own. So I'm in an area where there are quite a few of those within my proximity. So be a good investment. But yeah, with that, doing a lot of policies right now, a lot of unique things helping out a lot of clients and stuff, and just having fun. So with that, I'll pass it over to Mr. Linus.
Thanks, Brian. Linus Nolt here from Hopkinsville, Kentucky. Happy to be here, answer any questions, and provide any insight I can. We're still dealing with a bunch of snow and ice on the ground. Some roads still closed. Not great out here for Kentucky, but we're dealing with it. We're getting through it.
But just don't do what some guy in New York did, where he took his flamethrower to his roof and set his whole house on fire. Don't do that. Don't do that.
Nope. It's a good idea.
Go ahead, Tess.
Hey, it's Tess Hulek, and I'm grateful to be here too. 30 years insurance accountant, but life agent for a couple of years now. Grateful to be around the campfire, and I don't complain about snow and ice. I grew up in snow and ice. It's welcome, and I don't use the flamethrower, so I don't know about that one. Now let's see. They moved our square, so I'm not sure who's next. So whoever is in the middle, I'm going to guess Craig. Go, Craig.
Oh, here I am. Yeah, I think you guessed right. I was in the middle. I just didn't know if we shifted. But Craig Enney, coming from the south part of Denver, Colorado, where it's been summer all winter, and we're waiting for some snow and cold for once. But I did get a good dose of cold. I was in Lincoln, Nebraska a couple weeks ago. Woke up the first morning we were there, negative 28 degrees. Car wouldn't start. Took quite a while to get it going. But then when we came home, we left negative 20 something, and we arrived at 40 some degrees. I'm like, what a temperature swing for the day. But anyway, yeah, the 3-day was awesome, and Marius and I were working through some different vault strategies, and I thought it was really cool what Marius went through with the 4 different families working through debt. There was a family that didn't have any cash flow. There's a family that had cash flow, maybe getting into velocity banking. There was someone doing what we call the debt blaster trifecta. And then there was the person that over leveraged, put too much money out of their HELOC and their policy and got into trouble in a year or two. Anyway, hopefully you were all able to join us. And now I'm going to pass the ball over to, I think, Jason.
Got it. Right? Thank you, Craig. Thank you, buddy. Down here in City Beautiful, Orlando, Florida. They opened my new bike path today. So now I don't have to sneak around the fence illegally anymore. Shh. I can just walk down the new path. So super grateful to be here. The 3-day was awesome. I learned so much. You know, the money journey never ends. I like to say that we don't have money problems. We just have money patterns. So when you come, you see the community, you get to see all the different ways that you can control and have guarantees in this current environment. It feels good. And now I'm going to pass it over to Mr. Kevin Krause.
Outstanding. Thank you, Jason. Thank you, team. Kevin Krause, upstate New York, not too far from Chris. and very close to the headquarters of Security Mutual. Oh, there we go. There's the big screen. Rocking my fancy BYOB hat this time. It's a heat wave. It's like 30 degrees outside, so a lot of the snow is kind of semi-melting. Beautiful sunshine out there. Fun fact, we got the Super Bowl coming up. I don't know who's rooting for who, but somebody from my local high school graduated a couple years ago ahead of me, and he's an offensive coordinator for the Patriots. So we're kind of rooting for him and his team, and hopefully he'll get a ring. But other than that, hopefully we get some questions answered and infinite banking policies, money, etc. Let's have some fun.
We still have Marius.
Yep.
Yeah, guys, what about me?
Oh, Marius.
We didn't forget you, Marius.
Oh, no. Yeah, the young buck. No, everybody, Marius and Franco here in Buffalo, New York, where it is freezing cold and we're getting a lot of snow, but still I can enjoy it for about a month or two, and then it's time to book a trip down to Florida just to get at least some sun. But yeah, if you guys enjoyed the 3-day virtual event, that is awesome. We definitely have a lot more coming towards the vault. So Craig and I are super excited. And if you guys are not in the vault, well, get in.
There we go.
I think you have to come up with cute names for your scenarios, Marius. You know, like Craig has his Billfold and his Bucky Doe and Betty Doe. You're going to have some names too.
Yeah, I got to think of some names.
Let me know. I'll help you out.
All right. Well, everybody get those comments and questions in the chat box. And we'll go ahead and start diving into the questions. So get those in there. So we'll go ahead and start off with Lynn Green has a quick question here. Says, I got a question regarding the private equity that Congress just opened up. Knowing you can't give actual financial information, but does anyone know if that is something you can get with Charles Schwab? Private equity that Congress just opened.
I do not know what they're referencing. I can hear the Google search is going.
Yeah. Huh. I don't know. I actually don't know.
Steven, you guys aware of that with your WTF show? Anything come up on that? I don't know much about it.
No, so Lynn, any more information you can give us?
Well, I mean, Congress. So basically, they just said that, and so right now, to take advantage of like private equity deals and certain kinds of private funds and certain kinds of syndication deals and like real estate development projects, things like that, you have to be what's called an accredited investor. And currently, the only way to be an accredited investor is to have a certain amount of net worth or annual income, or I think if you're like a certified financial planner or an attorney, you can qualify that way. But with the new regulations, they're saying that you can take an educational course and do that instead of having to have a certain net worth. So if somebody that doesn't make 250 grand a year, have 2 million in net assets or whatever it is to be accredited now, instead of that, in lieu of that, you can take a course and kind of learn how to be an investor, and then that'll qualify you for these accredited investments. So it allows somebody making less money or not having the net worth to still be able to take advantage of accredited investing deals.
Yeah.
That is pretty cool.
Yeah.
Think about that. If you go out and educate yourself, invest in yourself, follow that fourth law of wealth, you get to go into deals you couldn't even touch before. That's pretty cool.
Yeah, when I was in that space a little bit, I remember the only thing that held some people back was the price tag to get into an accredited opportunity. Sometimes is a bit higher. The entry price is up there sometimes. Is Joe out shoveling snow in his shorts again?
Probably.
Probably, actually.
Dancing.
Yeah.
Don't doubt it.
All right. RWJ asks, just wondered if anyone knew more about the One America Long-Term Care, it's LTC, policy that I heard Hannah and Brent talking about on the video that came out yesterday. They mentioned how it was a great policy with a death benefit. I haven't seen that video, but
We have a guy on our team, Mike Samet, that's our long-term care guy and One America has some really great products for long-term care. So I would say reach out to Mike at chrisnoggle.com and he can help you out with that.
Yep. Yeah, I'm actually getting a quote for that exact thing here today through Mike and One America. So yeah, they got really good products, but yeah.
It's part of the journey, right? We're here talking about infinite banking and things, but what's Mike say? 1 out of 2 people are going to need long-term care. So, flip a coin. It's either you or your spouse, but one of you will probably need it. So reach out to Mike.
Mm-hmm. Yep. And by the way, it is a separate quote from like an infinite banking policy. Just keep that in mind. So some people think they're one and the same, but they're separate. All right, Dex, what's going on, man? Asks, when I graduate and the family gets the death benefit, or whomever is the beneficiary gets that death benefit, would it be taxed as income for them personally? So generally, no, but it depends upon how you have it set up, to be honest. Generally speaking, tax-free is how death benefits are paid out. But if you put them through a trust, there can be, depending on how it's set up, there can be potential taxes if the funds are not initially or immediately dispersed. So it depends on how you handle the funds. But if you're doing like a trust, by the way, make sure that your trust attorney also knows the tax implications of the trust, and they can explain it all to you if you're doing trust. So just that's kind of my answer on that one. Anybody else?
If you have a named beneficiary, Dex, I mean, that's going to go right to the named beneficiary without taxes. But we aren't CPAs. Like we need to have a little flasher down there, but we're not CPAs, tax attorneys, yada, yada, yada. But generally speaking, when you have a named beneficiary in the policy, that death benefit goes to them without taxes.
Yeah. No tax, no probate, just as long as it's set up correctly. Like as long as they're not under 18, right? You won't have to have a trust that receives that.
Yep.
I think estate planning also might have to do with that, right? What's the threshold? Like 15 for million for a single, and I think it's 30 for married. So that might change things.
Well, I mean, if the policy was going through a probate, or a estate plan, but usually it's outside of that.
Right.
But if you had inside of it, well, no, I won't get into that. All right, Dex, another question. If I set up a COLI, a corporate-owned life insurance trust, since so far all policies are One America, could death benefit just go into One America policies to pay off anything outstanding and remaining amount go to a trust account, avoiding going to bank?
Well, the one thing to think of, Dex, is a trust is going to have a bank account.
Yeah, I'm going to say that.
So you're going to, whether your policy is owned by the trust, and it depends, there's so many different types of trusts out there, but if you have an entity, it typically has a bank account associated with it. So I think what you're asking is, can you just have the death benefit from one policy go right into another policy? No, it's going to have to go into the account. You're going to have to set up a new policy with underwriting, and then it could go from the trust to another policy in the trust, but it still needs to go through that underwriting process.
And then I think paying policies pay off anything outstanding. So what do you mean by anything outstanding? If you're talking about like a policy loans, well, the policy that pays the death benefit would go away. So that policy's done. It's matured, they call it, or it's done. So the funds then have to go into a bank account first before they can go back into anything else. So it could go into a beneficiary's account, trust account, and then go into another policy to pay off loans, pay premiums, whatever, but it has to go through that bank account first. It currently as it's designed. What's this one? Streeper has a question here. Says, I got a 1099 from Lafayette. I'm curious if anyone else did. I called yesterday. Apparently it's for the dividend.
So if you had the dividend actually sent to you, that could cause 1099. I've also seen cases where if you have money sitting in a premium deposit account, so you're sending money in to Lafayette, they'll put it in like a side savings account to pay premiums in the future. That's an interest-bearing account as well. So it could have been from one of those two things. And if your dividend is not buying more paid-up additions, we need to get that fixed, Justin.
Yeah, so the question, I guess, is did you receive some funds from Lafayette? Did they send you a check or deposit funds into your account?
So definitely make an appointment with your mentor to help you through that.
Yeah.
Yep, that's a good question. And then this is a follow-up question to the other long-term care one. So back to that topic, can you explain a little bit about what a long-term care rider is on a whole life policy? Never considered this on any of my policies. So yeah, I mean, there's lots of riders that you can add to life insurance policies, and company specific, of course, as well. But some companies you can add a long-term care, so a portion of your premium is just going to go to that rider.
And I think sometimes people confuse the chronic illness and the terminal illness riders as long-term care riders. And
Oh, yeah.
a lot of times those are, depending on underwriting, those can be included in the whole life policy, which means if your doctor ever were to diagnose you with a terminal illness, or you had, similar to long-term care, you have to meet two of the 6 that you can't do, like eating, bathing, clothing, all those things. So the whole life policy will allow higher amounts of death benefit to be used earlier, but that's not necessarily a long-term care policy that would say, hey, if I go to a nursing home, I want X amount of benefit paid for X amount of time. That's where you want to look at an actual long-term care policy. And that's where Mike Salmon on our team, I think you asked before, but Mike Salmon's the guy to chat about that.
Yep, for sure.
And the way that, Craig, that was awesome. And the way that I like to think about is they're separate, right? One, we're doing to control the banking functions to have all the living benefits. And then you have the multiplication afterwards with the death benefit. Another one is really to give you the resources and the things you're going to need. So there are a lot of stories I've heard is a lot of wealthy folks might have plenty of money, but the long-term care policy actually gives them the resources and the connections to actually get what they need when they do need help. And it helps pay for that. So
yeah,
and then a different way to think about it.
Yeah. And if you're trying to put long-term care into a life insurance policy instead of separate, there's trade-offs. So, if you're ever considering that, just talk to your agent or mentor about the pros and cons of doing LTC inside of a whole life policy. Because long-term care will reduce death benefit and all that kind of stuff inside those. And it can even affect the cash value growth. So, and they're just, a lot of stuff going on inside those. All right. So Justin said, Streeper said, no dividends. Dividends went straight to the policy and not to him. So yeah, so I'm not sure why you received a 1099. Was there a dollar amount listed on it? Was it zero?
That's weird.
Yeah, that's strange. So
yeah, it's definitely something to look into. I'm suspecting that maybe you had more premium than could be used, and they stuck that in the premium deposit account because that will earn interest. But we can look into it. So if you reach out, like Tess said, to your money mentor, or even $80. Okay, yeah. So it could have been something like a premium deposit fund.
Yeah. Now, question for the team here. If you send them in too much premium somehow, will they take that extra amount, put into that fund?
Some companies will, some will ask you what to do with it.
Yeah.
And then in my experience, sometimes the unfortunate things is there's not a trigger to automatically tell them, in my past experience, trigger them to tell us that there's money sitting there. So sometimes you got to trigger them to do something. So Justin, I definitely talk to somebody, because if it's sitting there and somebody hasn't spotted it to move it, you want to address it now so that you're not having the same thing a year from now.
And know where your money is what Tess is saying.
Yeah, nowhere, because I'm going to say, just from past experience, and I haven't been in the industry in the day-to-day stuff in a couple of years, I never liked on-account money because there wasn't a tickler system in those days. There may be now, but money could sit there until somebody made it a project to look at it, to go after it. So you might have a little bit of money that could reduce a premium deposit down the road.
That's like the article I read about Starbucks the other day, where they would be in the top 2% of all banks, nationally. And they have over, I think it was $1.2 million of people just leaving money sitting in their accounts that are unaccounted for and don't even know it's there.
Yes. Yes.
Yeah. And in Care Life, he says, it could be the dividend withdrawal option, but I don't think he said he got any funds, received any that he's aware of. So I'm not sure on that one.
Yeah, that's what he said. He didn't get any. So I agree.
knowing Justin's policy, it's not that old yet. He would not have been taxed on dividends that he withdrew yet because he would not have exceeded cost basis yet.
No gain.
Yeah.
Okay. That's interesting. Yeah. So definitely let us know what you find out on that one. Be curious to see what.
Yeah, you're a regular. He's here every week, right? Yeah. Literally every week. So we appreciate you, Justin.
Yeah. Damien, man, how you doing, man? He says, can I transfer my TSP account to my policy? Now, for those of you watching this or recording, TSP is like a 401k. It's just a more of a government or teacher one. Is that right? Teacher one? Yeah.
Military, military for him.
Any government.
Yeah, so government. Yeah, so bottom line on that one, maybe not. There's a lot of factors involved. If you work with that, if you're still employed with them, you typically can't touch it. You can't even liquidate it. In some cases, you'd have to ask the manager of the TSP. If you don't work there and you can withdraw it, you can withdraw it. You can't transfer it. That's going from a qualified plan, they call it, to a non-qualified. That's not allowed. And love the IRS and all their rules, but they want to get their blood. So you've got to, if you take it out, that could be a potential 30% hit. So 20% tax, 10% penalty, and then you have cash, and then you can put it into the policy. And that can or cannot make sense. Just depends on you, your situation, and what you're trying to accomplish. So I have a lot of clients with TSP accounts, by the way, a lot. Can you do TSP loans, like a 401k loan? I think you can, right?
Do not know.
I think you can. I thought you could, but I can't remember.
I got rid of it a long time ago. I rolled it into my current, job or whatever. So I don't have that info.
I could be wrong, but I think that a client we talked to said, only as long as you're still currently active.
Yeah, I don't know that one. That's a good one, because why I'm curious on that one, because obviously 401k, yes, TSP, I'm not quite sure. But if you're looking to use that to fund the policy, there's other ways to leave the TSP intact, borrow from it, fund the policy, pay the TSP back. You're actually essentially doing infinite banking in two places almost. So yeah, I have some clients that are doing that right now, actually. So, and something that just came up. So I wanted to share this before we get into the next question here. So I had a client right now who has a large 401k, 150, 300, something like, they can borrow 50K. They have around $40,000 of high interest credit card debt. What do you think I mentioned that they could potentially look at doing? Borrow from the 401k at 7% and pay off the 29% credit cards, pay back the 401k loan, and they're saving all that interest.
So IBC with their 401k.
Yeah.
I just literally had someone do exactly that, Brian. He had an average of 27.5% on like 8 different loans, right? Different credit cards, different debt consolidations, and makes pretty good money, was saving pretty good money into qualified plans. And he didn't have a lot of liquid capital to get it started, overfund it, get control of it. So he took exactly what you're saying. He took a loan out, funded the policy, taking his first loan this week, I think. And now he's going to, knock out all those debts, and all that money will just flow back to paying the loan back. And he just, instead of continuing to contribute, he just said, okay, what's the amount? Like his research was, how much money when I take this $50,000 loan from my 401k do I have to pay back to make it whole again? So that was the equation he played.
Yes, he's saying yes, you can. Yeah. So the client I was doing this with, they weren't in a position where they could do infinite banking right now, and they're like, oh, sucks, because they want to get rid of all this debt. But then that's why we ask questions. What do you have? Oh, I got a 401k. I got this. I'm like, well, can you loan for it? Yeah. Then all of a sudden the light bulb just went off, and they're like, oh my gosh, I'm going to save how much in interest every month? 20-some%. That can change things pretty fast. So pretty cool.
Yeah, it looks like the current TSP loan interest rate's 4.25%. So that's actually pretty solid.
That is awesome. Oh, and he said, yes, you can, but you got to have your spouse's permission if you're married. That's interesting. Learned something new there.
Yeah.
All right. So Lynn, you're asking, what do you click on to pay money back to your loan or your policy loan that you take out?
I think it depends on.
Well, it depends on the company, by the way. So with my Lafayette, I click on the loan tab and I say pay loan, and it asks me how much. That's it. And it takes it out of the account, and it shows up as cash value in about 10 days. Something like that. 10 days, I think, is what it is. I don't know about One America.
One America also has an online place where you can fill out and e-sign forms without even having to sign into your own portal. If you're having any kind of difficulty with doing this online, just call the carrier directly. They can typically process a policy loan repayment up to $5,000 readily over the phone, to where you don't have to mess with any of the forms. Like I said, up to a certain amount limits. Some companies 5,000, some maybe a good bit higher. But yeah, over the phone is an option too.
Yeah.
And if you are with, it looks like you're with Lafayette from the comment you just put in. So you have two buttons when you have to click on, but if let's say you're taking a loan to buy a car, you're going to structure $500 a month coming back into the policy as a loan repayment. You can actually set that up to be in auto mode. So you can do an authorization form. It says, hey, just take $500 out of my account, put it back in the policy, and keep doing that until the loan's paid off. Of course, you can stop that when you want to, but if you're doing any sort of regular loan payments, instead of just doing it manually, you can set it up on auto mode.
Yeah. Really? The military will never teach you to be rich?
Thanks for your service there, Damien.
Yeah.
Thank you.
There we go. I love it.
They may not teach you anything about finances, but I see some benefits in the discipline aspect that they teach people. So it's not all lost.
Yeah.
Now just transfer that discipline and all that physical fitness into your financial fitness, right?
Yep. And then Carter says, my question is too long for the chat. Yeah, you can put it in more than once and we'll read through it. No worries. So RWJ is asking.
Good to see you here, James. Hi, Mark. Hi, Jay. Sorry, just got to shout out to the people saying hello to me. I feel rude not to. So glad you guys are here.
Is Mike on the advanced services team? I don't think I've heard his name before. No, he's not. He's just one of our money mentors, but he's got training in long-term care and the credentials to go and get the quotes and stuff. So,
and if you were on the 3-day this past weekend, he was in the chat quite a bit.
Mm-hmm. Yep.
Yes, he does some advanced services around long-term care.
There you go. Yep, absolutely. Yep.
And then David's asking, am I able to transfer to a brokerage account or do I have to go to a bank, then a brokerage? It depends on if you're talking about transferring from the TSB, I believe you can actually, if it's a qualified brokerage account, you can, but it has to be a qualified account, a qualified plan, which is the IRS, by the way. So, but what you'd want to do is call up the manager of the TSB and ask them directly. And they'll tell you what you can move it into or not, and if you can move it or not, because you might not be able to even touch it right now, depending on your employment. Okay, let's see here. We got the question. So Carter's got a couple of questions that are kind of it's a long-winded question here. So Carter says, if I have $100,000 in my whole life policy, so cash value, I'm assuming you're talking about, and it's earning 6% annual simple interest, well, it's actually earning annual compounded dividend rate. So that's what you're referring to. Isn't that only 0.5% interest per month? Yeah. Just 6% divided by 12 or 6% divided by 365. It's whatever number you want to divide it by. That's the amount that's calculated. Resulting in somewhere north of 6,000 by year end. Yes. Anybody else want to explain this to the dividends and how they're calculated?
Yeah, I mean,
I was going to call him Craig.
That guy. I think the thing he wants to look at is if you get an illustration, that's really what you need to be working off of, because the math you're trying to do doesn't really work out that way. Let's say we start a policy brand new, have 100,000 in today, and I'm taking 6% of that. Shouldn't it be 6,000 by the end of the year? No, because there's cost of insurance in there. So what's actually happening is you're putting premium in, they're taking out expenses. There's daily compounding, and then there's a dividend that gets put on at the end of the year. So look at the cash value growth of the policy at the end of year one, end of year two. Now, let's say you're 5 years into the policy. Could you potentially be getting more than 6,000 than, you're saying it's 6%, but could you be getting more than $6,000 growth? Yes. But that's really where we need to focus on the illustration and look at the premiums in, the cash value out. The difference is, essentially you can kind of track what you're actually gaining every year.
Yeah.
And in the Vault software, when you upload policies, we actually do all that math for you and show you the cash on cash, the cumulative break-even points, all that good stuff.
And you'll see, like Craig gave a really technical explanation. Like if you have ever seen the comparison, like what would you rather have, a penny that doubles in value every day for 30 days or $1 million? Like a whole life policy, the what happens, like it's not an investment, but what happens with the uninterrupted compounding looks very similar, where it just goes flat, 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 and then it just starts going like this later on, right? That's how I would think about it versus expecting to be a certain amount in years 1 and 2 and 3. It's just going to get better every year.
Yeah, and it's not a linear growth. It's actually it does hockey stick a little bit, but every company also calculates dividends on your policy a bit differently. So it's just it's not a simple calculation. We even had the insurance companies. Was it One America? It was One America came and explained the calculation of dividends to us. My brain just melted.
Mine cramped. I had a cramp. I fell out of my chair and started rubbing my head. I didn't know what was happening.
Yeah. So. Yeah. It's pretty entertaining. But all right, so Carter has a follow-up to this one kind of, and this is going to be interesting. So he says, and if I move $100,000 from a HELOC that charges 8%, so it's an 8% rate, to fund the whole life IUL, I'm going to stop right there.
Yeah.
I'm going to stop right there. So let's just cut out the IUL out of this question and burn it in a big pile of garbage over here. So there's no such thing as there's whole life and there's IULs, and IUL is a version of IUL, but think of it more like, Dr. Jekyll and Mr. Hyde. And you can tell which one is probably the bad one. So if the whole life insurance policy, the charge is 5% to borrow 90% of that. So what he's saying here is borrow $100K from a HELOC that charges 8%, fund the policy, the whole life policy with like a dump in. You borrow from that policy, you can borrow 90% of the 100K within 30 days, and the interest rate is approximately 5 to 6% on most policy loans. Yes. Now I'm trying to find out where the second part of your question is in the comments over here. Is that the end of it?
That's the end I saw. I think that's it. I think you did great.
Yeah, I think my question is too long. So, I mean, what you're talking about, you can do that. You can go from the HELOC to the policy and then borrow the policy, but there's still a lot of moving parts and pieces that we'd want to work through on that. Like, what are you going to do with the policy loan once you receive the cash? What are you doing with it? All those things come into play. Do you understand velocity banking on the HELOC? So all that kind of stuff. Now, the Vault, obviously, software can help you map this out, depending on what you're doing, and we can help you with that. So I'm going to put the call link in the chat here in just a moment. Linus, you're going to have to tell me what that link is again. I keep forgetting what it is. I got to write it down and save it. But yeah, so there's some things going on. CDD. Okay. I'd like to jump in a car with Brian sometime within the next week and talk some real numbers.
Jump in a car.
About HELOCs, whole life policies, loan for investments. Yeah, for sure. I mean, you can reach out to me. I'll put my email in there. Yeah, so he's got a lot going. Yeah, it sounds like he's got a lot going on. But right now you're in the learning phase. That's kind of the fun phase. So just keep on learning. But yeah, I'll put information here in just a second for you. Do we have any other questions, or did we get through them all?
Already? I got a question for you guys. I don't know the answer to this. One of our other mentors has his brother's looking at getting a couple.
Is Jason talking?
Yes.
Yeah. You can't hear me?
Hey, Joe.
Hi, Joe.
You can't hear him, Joe?
HELOCs.
No.
It's happening again. Joe can't hear somebody.
That's weird. Well, if I may,
I think you're the only one I can hear.
Me?
Yeah.
You can hear anybody else right now. They're all talking.
No.
Also?
That happened a couple of weeks ago to me. It was super weird.
Yeah.
So the question is this guy's brother is going to start two policies on his 6-year-old and 1-year-old, but he's telling me he's going to do $12,000 annually.
All right, I'm getting out of this. I'll be back.
All right.
And he's going to overfund the one by like $40,000. My understanding is that the most that a juvenile can carry on their body is up to half what the parents have on them, up to $1 million, unless you can show from an estate planning perspective that they can have more. And that, I thought that was for all mutual companies. Is that true? Anybody?
What was it again? I didn't catch it.
So this father wants to insure both of his kids with whole life, but he's looking at Northwest Mutual. Okay.
All right.
And the policies, it's another mentor that we all know. It's his brother, and his brother won't listen to him. He's like, don't go to Northwest Mutual to do that. You should use one of the companies that support banking. But he's looking to do $12,000 a year. Well, there's a couple of things that are wrong with the whole equation. One, he's looking to do $12,000 a year on the 6-year-old and the 1-year-old, and he's going to overfund the 6-year-olds by $40,000. And my understanding is that you can only go up to $1 million of insurance, or up to half what the parents have, unless you can show from an estate planning perspective that they can have more than that on their body. Is that true?
No, most companies don't have a hard limit at the $1 million. You do have half, some even a good bit more. So yeah, it does vary a lot from one company to the next.
That is good to know. I did not know that. Can you have kids unequally insured? Like, could you do that big of a drop in on somebody that young and have them be insured for a heck of a lot more than the sibling?
You're probably not going to get a dump in because it requires term, and you're not going to get term on a kid. So that's your problem with. So the dump ins on kids are just hard to do. You can get a little bit in, but not much.
That's what my experience has always been. So when I'm looking at the scenario, I'm thinking there's a whole bunch of stuff wrong with this. Not even besides it being direct versus non-direct and all the other things, and not having a lot of choice or design, and on and on and on. But I was like, this seems weird from the beginning. It doesn't seem like real numbers.
I also thought there was a set number, like you said, Jay. It needed to be like $10,000 or $5,000 from all of them. If one's 13 and one is 5, they still need to be 22 to 24,000 kind of thing. You know what I mean?
Yeah, like the underwriting amount, like the total amount underwritten has to be very, very similar.
Very similar, within thousands.
Now, that being said, I have had it approved where the dollar amount, the coverage amount was different, very different. Premiums were the same. They were okay with that. So it's one, it's one or the other. Death benefit close to the same, or premium close to the same. Because in this situation, you had a 16-year-old and a 1-year-old. There's no way that the face is going to be the same. And so to make the premiums work, they were the same number.
I guess it's how you tell the story.
Yeah. Linus, wasn't there a situation recently with ours where we were talking about if we were out of state, out of New York, anybody in New York had to have it, whereas 50%. But if you're out of New York, they could do up to like over 100% or 125. Remember that conversation?
Yeah, that was one very specific company.
Yeah, Mass Mutual lets you typically do 125%. So they're more generous with kids policies than some of the others.
I think they did want equal though, as far as the kids goes, at least the 9 and 11-year-old that we were dealing with.
Yeah. There is a question out there I think Marius can run with.
Which is the HELOC one at Craig's?
No, RWJKTHXBYE. So my wife has a VGLI policy and we'd like to convert it to a whole life. Is that policy conversion limited in terms of a normal high cash value policy used for IBC? Marius just did one of these.
Yeah, we did just have this conversation recently with a client, and just got to make sure that VGLI policy, which it should be convertible, but yeah, with Mass Mutual, we had a client where it can be convertible, but only a 20-pay whole life insurance policy. So only up to 20 years, and it's not going to be a high early cash value. It's going to be all base, no PUAs.
Yep. Yeah. So you go to that. If you go to like some of the insurance companies, they'll list out the VGLI companies that they'll accept as a conversion over. And I've had the same situation where someone had one and one company would accept it and one wouldn't. So it just depends on who they accept.
And Mass Mutual will do VGLI, so that's one of them on the list. And there's not a lot of them on the list that will work well for infinite banking purposes, but like Mario said, it's all base, so we kind of have to play with that. But you can do up to a 20 pay on it, which is still pretty cool. That it's guaranteed conversion too. So that's the other thing. If you have,
that's pretty cool. I didn't even know what VGLI was. Veterans Group Life Insurance. For anyone else that doesn't know what the acronym stands for, just so you know.
Well, it's weird because it's called something else when you're still in the military, and then when you come out of the military, then I think it goes to a VGLI. Is that how it
is? SGLI, there's VGLI.
SGLI is the Service Group Life Insurance. Mm-hmm. That's the term that they make you get or sign up for when you join.
Here's another good question I had from an email this week, where I just asked somebody, hey, what were your takeaways from reading Nelson's Becoming Your Own Banker? His question was, why isn't this stuff mandatory? Like, we have all these other insurances you have to have, home insurance, car insurance, depending on the state, and just all these different mandatory. Why isn't it whole life? And I didn't have a good answer. I'm like, that is a very good question. We'd be a much different country if it was mandatory.
Here's my answer to that question. Because only about 10% of the population can actually qualify to do it.
Yeah.
So whereas car insurance, there's a reason why I got to do it, of course, but anybody who has a car can typically get.
Why do you say only 10% of the population can get approved for it? Just curious. Like, where did you come up with that number?
So this is, Chris has talked about this before too, I believe. If you look at the population, how do you qualify? Medical and financial. Okay. So if you look at it from the financial perspective, around 50 to maybe 65, 70% of the population can't do infinite banking. They can't qualify financially. So that's a big deal, because if 49% of the population is under the poverty level, they obviously cannot do infinite banking. That's a big portion of it right there. You look at the health.
How about if you were mandatory to do it before 1 year old?
There you go. That's what I was going to say. What else should be mandatory is when you're actually born, because then you can qualify pretty much 99% of the time.
Right.
But the older we get, the less we can qualify. But why I say 90% is because there's that younger generation is the ones that can do it the most easiest.
Joe's going to run for senator of New York. Yeah. That's his platform right there. 15-day-old life insurance. Let's go. Get them all going.
Health-wise, though, I think if I read the stats on this somewhere, I don't know where it was anymore, but it was like another high number, 60 to plus % can't qualify medically. That blew me away. But what's the biggest things that disqualify them medically? Well, it's going to be height and weight ratio. It's going to be blood, cholesterol, blood, and diabetes.
A1C. Yeah.
And those just wipe out so much. And then the other reason why I say that sometimes is that to qualify, and I'm talking about qualifying not just with the insurance company, but talking to us. You got to qualify through us, because we're going to look at you. If you don't have the right mindset, the right money habits, it's going to be hard to do this. But go read the book. Yep.
Jason, you were talking about why don't they make everybody get insurance, right? So when I joined the military, obviously that was it was like, hey, this is the insurance, right? SGLI, you get it. This is your term. And then after 14 years, I got out. I had no insurance. So in that case, I wish there was another option of doing not just that. They said, hey, yeah, you could do whole life, or you could do something else, right? They don't have that. It's just, this is what it is. This is what you're getting. And that's it. So all that money for the course of 13, almost 14 years that I paid into this SGLI is gone, right? Versus if I had a whole life starting right from the age of 17 when I joined, then you'd have that opportunity and have all that cash to be able to use for whatever you want to use.
Kevin, that hurt a little bit. Just think about that, everyone. So everybody talks about how inexpensive term is, but if you frame the question differently, if it only pays out 1 to 2% of the time, so 98 to 99% chance you'll never get any money from having that policy, then isn't it expensive no matter what the cost is, other than the peace of mind piece of it? So just something to think about. And Kevin, I wish I've had a lot of we serve a lot of military folks that come through, our clients, people that are around the campfire all the time on the team. And so A, thank you for your service, but B, I hear this a lot. Like even my partner in my podcast, one of his initiatives he wants is to really have more of a financial education for military folks, right? for knowing about this sooner. And I think we all have that opportunity to go out and plant more seeds and help more people and really make sure that this keeps spreading. So if you're listening and you like what we're saying, bring more people, invite them all. It's a big plus.
And if you think about the W-2 world too, there's a lot of group insurance purchase for people that is temporary, short, and gone.
Yeah.
We just have a system that we could do better.
The real challenge here is what Jason's talking about, is that, and what you're talking about, Joe, is that the older we get, the less insurable we become. So we really should be getting this thing when we're young. I mean, that would be a game changer. And I was reading The Case for IBC by Carlos Lara. It's a great book. I'd recommend that one, about infinite banking. And they talk about if 10% of the population did infinite banking here in the US, it would disrupt the banking system, the traditional banking system. So
yeah, that's why the aim, Brian, is to hit that Gladwell's tipping point, right? That was actually the first question. I don't know how much I love David. I think we get along pretty well. But within 3 minutes of meeting him, I asked, what's the plan? Like, what's the plan? How do we get to 10%? There's 300 of us here. Where's the other 3,000? Where's the 30,000? You know, there's all this darkness out there selling IULs and all these other things that don't work. Why aren't more people doing this? So.
Yeah, exactly.
Kevin, I have a question for you.
Shoot,
If you had a life insurance policy prior to getting one at 17, would you still be mandated to get that extra?
That's a great question. That's something I'd probably have to get with another family member who's currently in, to kind of see, like, hey, when they join, are they absolutely have to, do they have to have insurance,
right,
or are they just making us get it when we join? It's been so long, I can't say for sure.
Like when you signed, if it was a mandated 500,000 or a mandated 1 million, and you had that in death benefit coverage already, do you still have to get that term?
Right. I would say probably not, but I think most people, when they're 17, they join, they probably don't have any insurance, and this is just, hey, if I go to war or whatnot.
Right.
I do remember one little thing. I don't know if it was on the life insurance exam stuff, and they talked about the war exclusion, right? So that was one thing, since becoming part of the team and whatnot, talking about, hey, if we do bad policies for these soldiers, right? Is that exclusion still a thing, or are all these policies good to go for anybody who joins, gets a banking system, they're good to go? God forbid they do go off to war and end up passing.
Yeah. RWJ said, you're not required to get the SGLI when you're in. It's an option. So
it's not. But some companies have that exclusion and some don't. So it's important to know the actual contractual language of whatever company you end up going with. And then also the SGLI, from, I guess, some I've talked to, it sounded to me like the military or the government actually buys it. So it's not like you're paying for it out of pocket. Obviously, taxpayer money is out of everyone's pocket, but yeah.
Yep. All right, let's dive back into the questions. We've got some good ones that have come in. So HELOC Joe Kovacevic. This is not an incitement of HELOC. I love that. Home equity line of credit, everybody. But what happens to your available credit in a 2008 situation? I was personally adversely affected by them closing down credit lines. So he says also, due to home values decreasing, that's why his lines got locked up. For this reason, he's skeptical to use a HELOC for an emergency fund versus leaving cash in a policy, even if math says not to.
So during the downtimes, if you have a $100,000 HELOC and you owe $98,000 to it because it's deployed, they're not going to cut it away because you owe that much money. And during that time, and in the last time too, Chris would go from one bank, take out all the money, move it into another bank, and take that bank and move it around so that they wouldn't close the lines and everything was being used and still being available if he needed it. So there is definitely a way around that. I started my HELOCs in 2009, and I have never had a problem with anything getting closed or froze or anything because I'm actively using almost all of it.
Another thing to keep in mind, Craig, is call up the bank who's going to give you the HELOC and ask them what they will do, because they'll tell you, or ask them if you can get a good person on the phone or you have a rep there. What did they do in 2008? Because I believe is it CMG that said they've never locked down a HELOC.
Yeah, I've specifically called them and talked to CMG, and they told me they have never called one back. Doesn't mean they couldn't, but they never have. Now, the other thing too, the way I'd look at this is on a second lien versus a first lien. There's probably more likelihood that a second can get pulled back as opposed to a first.
Mm-hmm.
Makes sense.
We saw that happen when Wells Fargo did it. They did a huge pullback of HELOCs. So, but to Joe's point, that's because they weren't getting used. Like, oh, open lines of credit, shut that down, bring it back home.
Yeah.
So,
yeah.
If
You have to be careful with those small banks.
If you have a line for 100 and you have $50,000 in it, they can just go in there, flip the switch, and say, "Oh, you got 50,000 now."
Yeah. Yep. There you go.
Money not in motion does not make money.
There you go. All right. Good
That's a
question.
dangerous statement too, Joe. It's true. It's also
It's true.
every time you say it, I get a little nervous. I know Craig does a little bit too. At least I believe it.
I don't get nervous. I just believe you have to have reserves.
Yes.
Shauna, have no idea who that is asking if you sign up for one plan on the vault.
We're gonna be fired, Brian. You're done. That's it.
Who's this person? Can you upgrade your account in the vault easily?
Yeah, so Shauna had texted me this as well. Someone from the 3-day was asking, and I don't know if they can't post here, but so the question would be, you signed up, you have the Debt Blaster plan, which, you know, if you're a Christie Van person, that's typically what they're using because they're trying to get their debts organized and use some velocity banking. But now you're at the point where you can get a policy and you want to start doing what we call the trifecta, which is infinite banking, velocity banking, and the sequencing. Absolutely easy to upgrade. You just go into the profile, hit the upgrade, pick the plan you want, off to the races you go. So that's how it works.
Does anybody else hear Craig like speeding up when he's speaking, or is it just
you?
or is he just talking faster today?
Just you.
Just me?
Yep.
That's weird. It's like you're on 1.2 times, Craig. It's like I listened to a book. Sounds so fast. Might be just the audio on my end because my computer keeps locking up.
I don't know what he's talking about. Sounds normal to me.
Yeah. That is a great question. I love this one. Richard is asking, how would a mutual life insurance company and your IBC policy be impacted by a current reset? Now, by a reset, are you referring to an economic reset? I'm assuming that's what you mean. So here's the honest answer. So if you're talking about the 80 to 100 year cycle in the economy, you know, if you go read the book Fourth Turning, it talks about that, how our economy resets every 80 to 100 years. We're at the very end of that time frame right now, which is why we're seeing all this stuff going on. The insurance companies have been through this before. It's happened before, and they've never been impacted. They've actually were profitable during this exact same times, and nobody's infinite banking policies were impacted. So
100 years ago, no one had infinite banking policies, right? It was whole life policies that had cash value. And I think that's one, like when people talk, I mean, this is a personal pet peeve. Like when we talk about the Rockefeller method and different things, we talk how they were using, you know, the infinite banking concept. That's not really true. They were just using the cash value in a whole life policy that was being built over time. Because Nelson didn't really bring this to our attention until what was the book first written? 2010, 2000, something like
I
that.
think the book was 2000, but he was operating in the late 90s.
Yeah, it's 25 years old. Yeah.
Yeah.
Keep in mind, though, they used to call it privatized banking. So that was if you ever go back and look, the original name was actually privatized banking. There's a book called that. But that name was tossed out a lot years ago too. But I don't remember when it started.
By currency,
Privatized banking.
he might be talking about the dollar bill going to crypto or something to that effect.
Could be. I mean, if you're talking about that, then I mean, to have a currency reset, it's if you're talking about having it go to zero, it's happened before. By the way, our currency in the U.S. has reset 3 times, and it's been done in the last 100 years. So, I mean, the insurance companies were still profitable, still did business, so they're pretty stable. But if our currency ever goes digital, well, It already is digital, by the way. I can't remember what the percentage is already digital currency. So it's already kind of there. But I mean, to have it changed for like the dollar to not be the reserve currency, I think would be a generational change. It would take a long time.
The way I kind of look at this though is, where does the money that the mutual life insurance company have, where does that go? And then when you look at their balance sheet, Chris and I were traveling around with one of the insurance company, executives we work with. And as we're driving around this city, what was really cool is he would turn a corner and go, see that building over there? We own that building. Yeah. And then we drive down the street a little bit further. He's like, see that building? We buy that. We own that building. There were hotels. There were 26-story office buildings. And so the way I kind of look at this is these mutual or insurance companies own assets, real assets. And if the currency changes to bottle caps, well, those assets are going to be worth X amount of bottle caps. If the currency changes to it's all Bitcoin, well, there's going to be some Bitcoin translation to all of those assets. So to me, it doesn't really matter because those assets are real assets. They're physical things you can touch and they're going to be worth something.
Yep, exactly. All right. LaMarcus Watson says, I'm 40 years old, 89K in a 401k, make around 60K a year, and thinking about borrowing from the 401k to fund infinite banking, call scheduled for tomorrow. Am I in a good enough situation to make this work? Well, you'll find out tomorrow, hopefully, on that call. But yeah, so it's just math. So what you're going to want to see is just what an illustration looks like, what the math on that looks like, what the 401k payback looks like, and then your cash flow. So it's just a matter of knowing where your money's coming from, where it's going, and making sure that it makes sense to you from a cash flow perspective. And then the last thing I'll mention before anybody else is, if that accomplishes your goals, then most likely yes. But
well, and if are you trying to pay off debt? Because that could be one thing we have to model out. Or are you trying to build a policy to buy a car? And the purpose of what you're doing with that policy is really going to matter, because if you're doing debt, sometimes the numbers work. If you're taking money out of a 401k to put in a policy, then go buy a car, you've just created a bunch of debt things and not a lot of assets. So really need to model it out to figure out, will it work in a beneficial way for you?
Yep. Real quick here on this one, since this is live, will it be recorded on Chris Nago YouTube? Yes, it is there. It shows up typically this weekend. It'll show up, so you'll just see it there.
I know we're pretty close at time, but for the last one, just to add something to it, just come with your numbers. Like, come with where you have bad debt, what is the amount you owe, what's the interest rate, what's your monthly payment, and what are you paying? Like, just really come know your numbers, Marcus, and that'll really help whoever you have the call with provide you with the best plan for where you're at today and then where you want to be in the future.
100%. JF Ferg says, I want policies for my 12 and 6-year-old. What's a good amount to start putting in monthly? I mean, we can walk you through those numbers, but there's a few more factors that we would need to know to provide that answer. So, like, what coverage do you have?
Does he have a policy? You can't get it. You can't get one on your kids unless you have one.
Or you're uninsurable. But I mean, typically juvenile policies, they start out at, disregarding the other things we don't know yet, they start out at around $100 a month with most companies. I've tried to do them lower than that, but I've just never got them to work very well. I don't know if anybody else has.
It gets pretty difficult when the numbers get that low to make it work for banking. Yeah. I mean, you could always do something like a One America and do all base plus $10 in that case or something like that. But usually there's a lot of variables. So book a call. If you have life insurance, that'll help us. If you just come knowing how much coverage you have on your body, that'll help us. Just come knowing your numbers again.
Yep. All right. Craig, another question here. It says, why couldn't a whole life company be made the beneficiary of a term policy? So be our he. Forced term could be used like a term rider. Anybody want to?
No, I like how Craig's always trying to give us hard questions. Like, I really appreciate that. This one I don't understand. I would think it's kind of like a like say I'm the broker and I sell someone a policy, like I'm not allowed to buy the policy from that person, right? Like there's some kind of conflict of interest.
I think I know what he's asking. So because we use term riders inside the whole life policies to elevate the death benefit, so we can elevate the cash value very early on, what you're asking is, could we have a whole life or a term policy outside of it and then put it into the policy, I guess, as a term rider? You can't put a term policy into a whole life policy. It has to be built ahead of time. But I'm not understanding the beneficiary of being the whole life company.
So I'm going to make a guess what he's saying is that let's have a term policy on somebody, and when that person passes away, its death benefit is going to go to the life insurance company to fund a whole life. And it's not going to work that way. You're going to need to maybe have a trust in place for the death benefit to go to, and then the trust has language in it that requires its trustee to go take out a new whole life policy on this person that you really wanted it to go on to, and use some of those death benefit proceeds to fund it.
Yeah, similar to Dexter's question early on tonight.
Yeah. So in regards to military guide, not getting a whole life. Yeah, I don't quite think I understand the question, but we got one last one here. We'll grab real quick. I know we're over time here, but appreciate everybody being here. So Carrie Swanson says, Joe, can you explain how you keep all business income separate while using a one pot system? So what she's asking everybody is, if you have business income and private income, you got to keep them separate. But how do you do that if you have a one pot system, which is a HELOC and velocity banking, running your income through that? How do you do that if you want to use the business income for velocity banking? And
I'm excited by this one, Joe. Just so you know, I answered Carrie earlier. So I am excited to see what you say.
As you flow money into the business, you could do a capital contribution. When you do a capital contribution, that puts a set number inside of what money can flow back and forth. So if you have a $20,000 a year policy and you capital contribute $20,000 to the LLC, at any point during the year, $20,000 can be moved from that LLC back to your personal, run through the policy, and then you can keep on repeating and doing it. You could lend it and then pay yourself interest and have it be a write-off that side, but a simple way just to move, that money back and forth into that would be a capital contribution.
Yeah.
My answer was, Joe, my answer, you can tell me how you
I
like
lost
it.
Jason again.
Oh, no. Oh, well.
We can hear you.
My answer, Joe. My answer was just how we do it, because I
lost him. Really? Is he talking to me?
No.
Yeah.
Not a clue. I didn't hear a thing you said, Jay.
Well, let's let him.
You won't hear this next part either. Or are you going to say, Jason?
So go ahead, Jay.
Yeah. So what I would
the
say,
same
the way that we learned to do it, because I was going and putting everything we earned into the HELOC, right? And then what I realized was I was creating tax problems, distribution. So what I told Carrie is the way we do it is anything that's going to go towards the business stays in the business checking account, and everything extra goes into the HELOC. We put all the money in there, and we pay everything on our personal side with a credit card, and then pay it off with a HELOC once a month.
Brian, what's he saying?
Same thing on the business side.
Just answer the
I
question.
just keep them separate, completely separate.
So this is so funny. He was just saying he keeps a lot of this separate. He just keeps the business and the personal income separate. So, but you have to watch the recording, Joe, to know what he said.
Yeah.
Yeah, I can't hear nothing.
All right. So one last question. So we'll answer this one last question, and we'll let you all go. So Jay Ferg says, thanks. I want one as well, but hearing that only 10% get a policy is concerning. I mean, just have a phone call with us and we can walk through that pretty quick. If you're here, to be honest, most of the people that come talk to us can get a policy. So keep that in mind. What does taxes look like with the policies? Well, you fund the policy, post-tax, and then don't pay taxes on the growth inside the policy. It's pretty simple. And then can the mutual company up and leave with the money? Well, no. I mean, life insurance is a highly, highly regulated industry, so no. And then the mutual companies that we work with have never lost money, never got under, never gone bankrupt, never not been profitable. So they're very stable. So I would say to that, well, no, but then again, there's no guarantees in life. But this never happened. So keep that in mind.
There's also provisions and guarantees in the contract that wouldn't let them
I can't
just
hear
run
Dennis
off.
either.
Yeah.
And I would say compare that with a bank and just see what kind of rules they have with the bail-ins, not a bailout, but a bail-in.
Yeah.
I feel like we got to get Joe one of those shoehorn things to hear. Huh?
Q-tips. Let's buy him a box of Q-tips for next week.
We're gonna get you one of those big hearing aids, the old school ones with the big horn on it. That's what we're gonna get you, Joe.
Yeah.
I can hear Tess.
You can hear Tess and me.
Yeah.
There you go. That's hilarious. Oh, Bo, what was the video that Chris just did on the Chicago Bank?
Oh yeah. It just came out yesterday.
What was the question?
So Chris just did a video and put it out there on this bank in Chicago that is going bankrupt. 250 million just gone.
Oh,
they're not bankrupt yet. I don't believe, but they're on the way.
A bank in Chicago, wasn't it?
Yeah.
Chicago. And what Chris was talking about in the video is that the last time this happened, the banks that were going bankrupt back then, Chicago is where they started. So it's like Chicago banks went bankrupt first, and then it started rippling throughout the country at the last big crash. So.
And like you said, the insurance companies didn't experience
Metropolitan. That's what it was. Yeah.
Yeah.
Thanks, Linus.
The insurance companies didn't experience the same things the banks did when that all happened, like through 2008. But there's so many regulations into play and so many audits and so many oversight boards. And yes, I know because I've lived it and done it. I actually talked about it in the 3-day this weekend. They don't wait until they're at a point where they're in trouble. They're actually running ratios and looking at insurance companies every single quarter and letting the state of domicile know, and they will come in. I actually worked for a company that came in one day and said, "You work for me now."
Mm-hmm.
I was listening. I loved when you shared that on the 3-day. Tess has some great stories. If anyone missed the 3-day or didn't get to watch her section, go back and watch it. It was really powerful.
Thank you.
Cool. Well, we made it through another Ask Me Anything. Appreciate all the questions. Let me go ahead and post I'm going to post really quick the scheduling link here for the mentors. So there's the link right. Whoops. I just sent it right back to you, Linus.
And thank you, Craig. You're just showing our genius.
Yep.
He's not posing tough questions. But either way, bring tough questions. Like we like different new questions. I don't know a lot of answers, to be honest. Like I will keep raising my hand and say, I don't know, but I'm going to find out for you. So
and can you have you here too, Marius?
Absolutely.
Yeah. Well, appreciate everybody. With that, we will see you on another Ask Me Anything next week. So take care and hopefully talk to some of you on the phone here pretty soon.
Take care.